Before you react to that title, before you assume this is another fear-based video designed to get you to click and panic, I need you to take a breath and hear what I'm actually about to tell you. There is no new law that suddenly gave banks the power to freeze your account without any reason. That's not what's happening. What has changed in 2026 is the enforcement mechanism and the timeline requirements for a specific category of account holds that have existed in banking regulations since the Bank Secrecy Act of 1970. What has changed is the practical effect of these enforcement changes means that if your account gets flagged, whether correctly or incorrectly, the freeze can happen instantly, often before you receive any notification, and the bank is legally prohibited from telling you why for up to 60 days. That's not a conspiracy. That's not a theory. That is the documented regulatory framework that went into full enforcement on January 1st, 2026, under FinCEN Notice 2025-R08, and it has already resulted in over 40,000 temporary account holds in the first 8 weeks of this year alone. I want you to imagine something specific with me. It's a Friday afternoon in March. You're at the grocery store. You filled your cart, $174 worth of food for the week. You swipe your debit card at checkout. The screen says, "Card declined." You try again. Declined. You ask the cashier to run it as credit. Declined. Confused, you tell them you'll be right back. You step outside and call your bank. The automated system says your account balance is $8,200. That's correct. It's exactly what you expected. But when you ask why your card isn't working, the representative says, "I'm showing a temporary hold on your account. I don't have access to details about why the hold was placed or when it will be released. You should receive a letter in the mail within 5 to 7 business days." You ask if you can withdraw cash at a branch. They say no, the hold restricts all account access. You ask if your mortgage auto pay will process on Monday. They say holds typically block all outgoing transactions. You go home. You check your email. Nothing. You check your mail. Nothing. You log into online banking. Your balance shows $8,200, but there's a red banner. Account temporarily restricted, pending review. Your mortgage payment bounces on Monday. Your electric bill autopay is declined on Wednesday. You have no access to your own money for 11 days. Until a letter finally arrives, explaining that your account was flagged because you deposited 3 checks in the same week, totaling $6,400. Birthday gifts from your children, a small inheritance from your uncle's estate, and a reimbursement check from your insurance company. The letter says the hold was released. No apology, no acknowledgement of the disruption. Just a notification that your account access has been restored. This is happening right now. Not to criminals, not to people laundering money, to retirees whose account activity triggered an automated suspicious activity report under regulations that require banks to freeze first and investigate later. The Bank Secrecy Act, originally passed in 1970 and substantially amended by the USA Patriot Act in 2001, requires banks to file suspicious activity reports with the Financial Crimes Enforcement Network, FinCEN. When a bank files a SAR, federal law prohibits the bank from notifying the customer that a report has been filed. This is called the anti-tipping provision. What changed in 2026 is FinCEN Notice 2025-R08, effective January 1st, 2026. Banks may impose immediate account restrictions when filing a SAR, and the restriction may remain for up to 60 days. Pattern 1, structuring. Multiple deposits or withdrawals just below the $10,000 reporting threshold. Example, depositing $9,500 on Monday, $9,200 on Wednesday, and $9,800 on Friday. Pattern 2, rapid movement. Large deposits followed immediately by large withdrawals or transfers to third parties. Example, $15,000 deposited Monday, $14,000 withdrawn or wired out Wednesday. Pattern 3, inconsistent activity. Sudden unexplained changes in account activity levels. Example, an account that typically sees $3,000 a month suddenly receives $40,000 in a single week. Pattern 4, third-party transactions. Frequent payments to individuals or businesses with no clear relationship to the account holder, writing checks to multiple different people in rapid succession. Pattern 5, geographic anomalies, transactions occurring in locations inconsistent with the account holder's known residence, ATM withdrawals in 3 different states in a 48-hour period. Every one of these patterns can occur legitimately in retirement. You sell your car and deposit the $12,000 proceeds, then write a check for $10,000 to your son for his small business startup. That's rapid movement. You receive 3 inheritance distributions from your mother's estate, $8,900, $9,100, and $8,700 within the same month. That looks like structuring to an algorithm. Component 1, source documentation. The practice of maintaining clear, accessible records that explain every large or unusual deposit before it hits your account. Meet Richard. He's 70 years old, retired from automotive sales. In January 2026, he sold a classic car for $16,500. The buyer paid with a cashier's check. Richard deposited it. 2 days later, his account was frozen for 14 days. Meet Patricia. She sold her RV for $23,000. Before depositing, she made a copy of the bill of sale, copied the cashier's check, and brought documentation to the bank teller. No hold, no freeze. The teller made a copy, attached it to the deposit receipt, and notated the account. Customer provided documentation, RV sale, see attached. The deposit posted normally. Step 1. Before you deposit the funds, create a paper trail. For vehicle sales, signed bill of sale. For inheritance, estate distribution letter. For insurance reimbursements, claim settlement letter. For gift checks, written note from the giver. Step 2. Make copies of the check or money order, front and back, before depositing. Step 3. Bring documentation to the branch when you make the deposit in person. Step 4. Keep a file, physical or digital, of all large transaction documentation for at least 24 months. Component 2. Transaction spacing. The worst thing you can do when you have multiple large deposits or payments is to complete them all in the same week, just to get it over with. Meet Frank and Carolyn. In March 2026, they had 3 large financial events: a $14,000 tax refund, $11,500 from jewelry sale, and $6,800 insurance settlement. Total incoming, $30,000 to $300. They deposited all 3 checks on March 4th. They made all 3 payments on March 6th and 7th. On March 8th, their account was frozen for 19 days. Donald and Elizabeth had the same situation, but they spaced deposits 1 week apart. March 3rd, March 10th, March 17th, and payments were spaced days after each deposit. Due to the algorithm, Donald and Elizabeth's account showed normal activity. Periodic deposits followed by normal intervals before logical withdrawals. No clustering, no rapid movement, no flag. Rule 1. Space large deposits at least 5 to 7 business days apart. Rule 2. After any deposit over $8,000, wait at least 3 business days before making any payment over $5,000. Rule 3. Space multiple large payments across different weeks using different payment methods, one by check, one by ACH transfer, one by wire. Rule 4. Never make multiple deposits of similar amounts just below $10,000 within a 30-day period. Even if legitimate, that is the textbook definition of structuring. Component 3. The written notification protocol. You have the right to proactively notify your bank of upcoming unusual activity. And when you do it in writing, you create a compliance record. Meet Helen. She's 67, recently widowed. She received a $47,000 distribution from her late husband's life insurance policy. She only called the bank verbally. Her account was frozen for 12 days. Meet Thomas. Same scenario, $52,000 life insurance payout. 10 days before the check arrived, Thomas visited his branch manager and asked him to document the upcoming deposit in his account notes. Then Thomas went home and sent an email to the branch manager with subject, written notification of upcoming life insurance deposit. He included his account number, policy number, and the expected amount. The branch manager replied, "Thank you for the notification. I have documented this in your account file. Please bring a copy of the insurance settlement letter when you make the deposit." When Thomas deposited the $52,000 check 2 weeks later, it posted without issue. No hold, no freeze, no investigation. Because it was expected, documented, and explained before it occurred. Use the written notification protocol for life insurance payouts over $25,000, inheritance distributions over $15,000, legal settlements over $20,000, sale of real estate or vehicles over $15,000. Step 1. Visit your branch and verbally notify the branch manager 7 to 14 days before the transaction. Step 2. Send a follow-up email with your name, account number, description, source of funds, and timing. Under 31 CFR, paragraph 10 to 20.320, banks are required to file suspicious activity reports for any transaction they have reason to believe involves funds from illegal activity. The regulation does not require the bank to prove the activity is illegal, only that they have reasonable suspicion. You can disagree with these regulations. You can advocate for changing them, but you cannot ignore them. They are the enforceable law, and they apply to your bank account right now. Meet Margaret. She's 71, retired school teacher. In February 2026, her sister passed away and left her $35,000. She deposited it via mobile deposit with no advance notification and no documentation. On February 13th, she wrote a check for $22,000 to a contractor for kitchen renovations. On February 14th, her account was frozen. She discovered this on February 17th when she tried to pay for groceries, and her card was declined. She called the bank. They told her there was a hold and they could not provide information about why or when it would be released. She had to borrow $200 from her son to cover basic expenses. On March 8th, she received a letter stating the hold had been released. 23 days later. Total cost, $95 mortgage. Late fee, $35 car payment late fee, 2 negative marks on her credit report, 23 days of stress and confusion. All of this was preventable. The difference between Margaret's experience and Thomas's experience was not luck. It was not bank favoritism. It was structure and communication. Step 1, create a large transaction file. Step 2, implement transaction spacing. Step 3, use the written notification protocol. Step 4, know your rights during a freeze. Step 5, maintain a backup account. If your account is frozen, you have the right to request a timeline for resolution. You have the right to withdraw funds for basic living expenses in some states. You have the right to close the account and take your funds to another institution after the hold is released. Maintain a backup account, just like in the Chase closure video. Maintain at least 2 active checking accounts at different institutions with operating funds in both. If one is frozen, you still have access. The 2026 SAR enforcement changes are real. The account freezes are real. The 60-day holds are real. But the solution is also real. It's documentation, it's spacing, it's communication, it's structure. You spent 30 or 40 years building the savings in your bank accounts. You deserve to know how the anti-money laundering regulations work, how the algorithms flag transactions, and exactly how to structure your banking activity so you remain completely transparent while avoiding false positive freezes that lock you out of your own money.